Hi, this is Jessica Herring with Finance of America. I am a mortgage advisor, and if you've seen any of my other videos, you probably already know that I have about 15 years of experience in lending, banking, and finance. And for the past 3.5 years, I have been doing specifically mortgage lending. Mortgage lending is a passion of mine because I get to help people purchase and or refinance their dream home. So that's very important to me. I want to talk a little bit today about a few mortgage terms that you may or may not be familiar with. Sometimes we hear things that don't make sense or we don't know to ask. So the first one I want to talk about is the acronym PMI or MI. And PMI is simply private mortgage insurance, or mortgage insurance for short. That is required on most loans, not all, but most loans that have a down payment of less than 20% on them. So the bank, the investor, is going to require that you purchase a separate insurance policy that strictly protects them from you defaulting on the loan. I know it sounds mean, doesn't it? But they're taking a bigger risk than you are because you're not paying down the large down payment of 20%. So it kind of only makes sense that you help them out a little bit with that insurance. Now, if you want to avoid PMI, we have ways of doing that that don't always require 20% down. So it just depends on what loan program you choose. And there are many, many out there. And I'd love to visit with you about that specifically. I mentioned a mortgage investor. A lot of times that can be a confusing term as well, but the mortgage investor is the entity that is providing the dollars to purchase your home. And so you may have a bank that you're going through, or a mortgage broker, or a mortgage bank, and they may or may not be the mortgage investor. So a lot of small banks and community banks, that's my background, they do portfolio loans, and they are the investor. They provide the money for those loan dollars to fund at closing and pay the seller. And so if you go through another bank, or a mortgage bank, or a mortgage broker, and you do conventional financing or FHA financing, your investor is going to be a little bit larger. It might be the actual FHA, or it might be Fannie Mae for conventional lending. So your investor is the one providing the dollars for the loan at closing. It's the one that's actually purchasing it. Your servicer, another term, a servicer, is the entity that you make your payments to. They're the ones that take care of making sure your loan interest gets applied, your loan principal gets applied, and if you are escrowing your taxes and your insurance. And that brings me to the last term, escrow. Escrow is something that is required typically, not always, but typically, again, if you pay down less than 20% on your loan, there are some stipulations. You can still do it, but there's a few things that a few other boxes you have to check. And one of those is escrow. And most lenders require that you will put your county taxes, your annual county taxes, and your annual homeowner's insurance or your hazard insurance in escrow. And that just means that every month they collect 1/12 of the annual payment, and then at the end of the term they pay that for you. And that's just another way that they can make sure that those payments are being made on time and there's no additional liens placed on the property when they are the main lien holder, the first lien holder. So if you have any other questions regarding mortgage financing, lending, or anything to do with any of these terms I've mentioned, or some that I haven't mentioned, please reach out to me on Facebook. You can send me a message. You can reach me on my Facebook page at Dream Loans for Dream Homes with Jessica. Thank you for listening, and I hope you have a great day.